Let's bring in Tobias Levkovich. He is the chief U.S. equity strategist at Citi for his 2020 vision. Your vision's a little cloudy, it sounds like. You are only looking for modest gains in the year ahead.
If I take off my glasses, you see how thick my lenses are.
What are you having trouble seeing through?
So look, I think there are four things that can drive the market. One of them actually happened this past year, which was sentiment was so poor entering the year, and everybody talking about multiple expansion. That was the sentiment factor that swung from in our panic euphoria model, deep panic, into not even euphoric territory today, which is kind of interesting. The market may be at highs, but people aren't that ebullient. Number two would be money flows, but we really haven't seen that other than corporate buyback activity. We haven't seen that for 8 of the past 10 years, 5 of the past 5 years, despite the S&P's pretty much doubled in that 5-year period. Third thing would be if you were to get valuation really cheap, which you really don't have today. And the fourth one would be earnings. So you're really banking on earnings at this point. And we think earnings can be up about 5% or so. And that's what really carries you. Do you get an overshoot is the one question initially. And I think the first half you do. Economy's a bit better. People will feel better. Earnings will show up. And there'll be this kind of confidence returning. It's the second half that gets a little shakier.
So it's going to be a top-heavy 2020.
Our sense, it's, with all apologies to Dickens, it's a tale of two halves. That the first half is one that's a little bit more rewarding, and the second half you run into the elections, you run into data around lending standards getting tighter means a weaker second half. Volatility lead indicators, profit lead indicators, all of those suggest something a little bit more challenging in the second half.
Is there any sector that could withstand the volatility or the uncertainty in the run-up to the 2020 election?
You'd like to think so, but it's again, I think it's going to be a little bit more cyclical, a little bit more value-oriented in the beginning of the year. And when I say value, I don't necessarily mean just cyclical. So, for example, healthcare can participate. But then you start talking about the elections, and can healthcare maintain it if people start talking about Medicare for all, for instance?
Isn't this outperformance in healthcare a lot of it predicated on who runs on the Democratic side, if it's Elizabeth Warren or not?
So, it's interesting as you go through it. If you say it's a Biden, I think you're fine. If Peter Buttigieg is viewed as kind of a moderate, but actually, if you look at some of his policies, he's not that moderate. Certainly, if it's a Sanders or a Warren, you have more problems on the healthcare side. But I'm giving as an example. That's one of the issues that's certainly going to come up in election.
But if you get 5% earnings growth, and I will just say what Kramer just said. Don't fight the Fed. You have a friendly Fed, and you get some earnings growth. What's the problem?
Again, I think you can see the market run to 3,500 before it backs off to 3,375, which is our year-end target. You're still making money. It just isn't going to be the gangbuster year that you have this year. And I would say I differ a little bit from Jim, and sorry, Jim, if you're watching, where I think the Fed issue last year was the fear that they would cause a recession by going another 4 hikes. Right? By April and May, we didn't have that as an issue for the Fed, but we had fears around trade wars causing a recession. Then by summertime, we were talking about inverted yield curves causing a recession. And by September, October, we were talking about ISMs below 50.